What is happening, Bigger Podcast? It's Matt Faircloth. So, it's 2021, guys, and for those of you guys that didn't notice, 2020 was an absolute dumpster fire train wreck falling off a cliff. And we're all looking to reboot and do deals in 2021. Not that a lot of that mess is over, but a lot of us want to continue to grow our businesses. And the world has changed because of the dumpster fire train wreck going off a cliff. There's a new world out there, and we all want to do business, and the world is not the same as it was this time a year ago, but there's still deals to be done. Those of you guys that are watching that want to do multifamily deals, whether it's your first deal or your 111th deal, the market has changed, and the parameters to do deals now has changed than it did just a year ago. And so me and my partner Hervé, who does all the acquisition management for the DeRosa Group, and you can check him out on our YouTube page as well through his Market Hunter Thursday with Hervé show, he and I were sitting down talking shop about the things that really matter to do deals in 2021. We came up with 3 M's. The 3 M's to do your first deal in 2021, whether it's your first deal ever or your first deal in the year. Like I said, I'm gonna need some help. Hervé and I were talking about it, so I'm gonna bring Hervé in here.
What's going on, everyone? Happy 2021. Hope everyone is safe and has been safe. Had a great holiday. So excited to be here with you, Matt. Let's do it, man.
You too, brother.
What's going on?
Hervé and I were sitting and chatting, right? And Hervé, you and I were saying, like, what really, there's a lot of things that matter.
That's right.
In doing deals.
Yes.
You know? But there's 3 irreparable, immovable things that you have to have in place and that you have to be in strong considerations to make deals
Absolutely.
work in this new economy, this new world we're in, right?
Yes, sir. Yes, sir.
3 M's, right?
3 M's.
So hit it with us.
Number 1, markets.
Markets, guys. Market is the number 1 M you got to consider, right? Okay, what do you mean by market, Hervé? What is that?
Listen, on the markets, in the spirit of transforming lives through real estate, right, we go ahead and we select the markets that are going to best identify where you want to start and grow your portfolio to generate great cash flow for yourself, for your investors, and you want to specifically choose that market where all of the metrics that you use to identify a great market satisfy the ability for you to generate great returns in not only a market growing for the short term, but for the long term as well. And that's taken so much into consideration, not only in regards to when you think about population growth and economic growth and job diversification, but let's be real, of course, because of what happened last year. Listen, migration trends started happening before 2020. It accelerated in 2020 to the point where you cannot ignore markets that are getting hurt by migration. Exports, we talked about it today, New Jersey, unfortunately, New York, right? Some of these northern, more and more folks leaving these markets, going where? No big surprise, places down south such as the Carolinas, Georgia, and Florida.
And it was already happening.
It was already happening.
COVID happened, and that's something that you guys should like kind of mentally write down. COVID, absolutely awful, terrible thing that has happened. But what COVID did, well, and on a positive note, is COVID sped up lot of the advances and changes that were happening in our society. People working from home, migration from cities and into new places, and the dissolving and the changing of shopping malls and changing of office buildings and other things. Right?
Absolutely.
It's going to expedite all that stuff. But going back to what you said about market, I'm kind of playing devil's advocate and pretending I'm one of the viewers or readers here and saying like, so you're telling me that I can't go out and buy a property anywhere in the U.S. I will buy. I can't do that?
You can do that. It could hurt you. You want to be selective in regards to what markets you choose, how you choose them, and why you choose them.
Right.
If you're not comfortable really going outside of your market, okay, you can investigate. Believe it or not, there's still opportunities here in, for example, states like New Jersey and New York. If you are comfortable and there's any reason why you should not be comfortable, definitely venture outside and do the work. And again, it's some of the more very simple factors when we start talking about population growth, when we start talking about median income, the amount of renters, and again, migration, and really job diversity. So for example, there are some places that we check out, we're like, oh my gosh, Matt, you know what, we love this market. There's others, particularly in the areas of down south, not so much.
Specific deal that we looked at that we're going to buy 100 and something units, right?
That's right.
And Hervé's, again, our acquisitions manager, so he was running the numbers with our underwriter, looking at the deal, and what came up for you?
Well, what came up was that it was a value-add deal. It's what we like, it's a value-add deal. There's opportunity to go ahead and come in and do renovations, bump up the rents, lower the expenses if we brought in the right property manager. But what was our concern even after all of those nice benefits? The market. Specifically that this was a city of only 27,000 in population, and you had one industry that made up about 20 to 25% of the jobs.
What happens if that industry shifts? What happens if that industry
There
shifts?
goes the rent bumps,
Yeah,
there goes
man.
the expenses, there goes
Yeah.
all of the underwriting, all of the analysis that you did, poof, out of the window.
Here's the DeRosa tip for our company. We look at markets that are not driven by one economic sector, right?
That's
So
right.
you're
That's
not going to see us invest in a market that are 100 that are like, big driven by oil and gas or by other sectors or whatever. it is.
Tourism or whatever.
Right.
That's right.
And then more important during COVID, because COVID will likely spill out into changes in a lot of market sectors, potential recessions and things like that. They're going to pull things down, push things up. So if you're in a market where there's an industry, whatever it is, if that industry is going to have a major shift because of COVID, you're going to be subject to it for the good or for the bad. With COVID, COVID aided some markets because of
That's right.
and it hurts certain markets. Let's just talk about Orlando, right?
Orlando
you couldn't touch
I can't
before
touch it.
pre-COVID, right?
That's
Because
right.
and everything like that.
Everybody
but
was
now,
rushing to Orlando.
and now Orlando's not so much the place to be.
Exactly
So if
right.
you guys want to kind of like get in on bargain, not that Orlando's everything's discount or Vegas or whatever, but those were markets that were big tourism centers. Tourism's not the big thing because of COVID anymore. Maybe it changes. Maybe you want to roll the dice and get into a market
Lot of
and see
maybes.
and see if it's at the bottom.
That's right.
But we prefer markets that are on the rise post-COVID. So that's a factor, a COVID factor, 2021 market factor. We had another deal that was one property and it was surrounded by two much larger properties.
Yes, right.
It was kind of the little fish on the block. It was a multifamily, but it was much smaller size than two other properties around it. And we ran the numbers,
That's right.
and you and the underwriter came up with the equation that if the rents drop, how much what happened?
In the event that the rents in this particular property drop by only less than $50, let's say between $48 and $50, right, then it's going to wind up eating into our returns. We're not going to be able to go ahead and deliver. And the worst part about it is we can wind up getting squeezed by these two bigger multifamilies that were bookmarked, to this 100-unit property that we were looking at. So it's just too much risk. One of the things we were talking about earlier, again, going into 2021, discussed about markets, make sure that the deal that you're looking in the market that you choose is cash flowing day one.
That ties us to the next M, Hervé,
The next
which
M?
is
Money.
money, guys.
We need money.
Number two.
The dinero.
Now, what do you mean by money? Let's talk about that. Market number one, money number two. What do you mean by money, Hervé?
Obviously, from the money, we're talking about on both sides. We're talking about the equity. We're talking about the debt. We're talking about how you're going to plan on financing this deal that you found whatever market that you have chosen to find this particular deal in.
Because
And
pre-COVID, different financing was different, man.
financing was
There
very,
was
very
bridge
different.
loans,
Things were
but
open.
money was more free.
The banks were more open.
Equity's
So-
still not that hard to find post-COVID, believe
That's
it or
right,
not.
that's right.
But debt has changed. The debt world is completely different now, right?
Completely changed.
Yeah.
Got interest rates are much lower, and so on and so forth. And even though interest rates are lower, the banks see the inherent risk right now, even more so depending on where you are investing. So let's say you find that great multifamily in Orlando, like you're talking about. Guess what the banks are going to tell you? All right, well, you're going to have to put in an additional reserve for COVID, an additional reserve for COVID, an additional reserve
You
for
might have
COVID.
to put you have to put 12 months worth of
And maybe
principal
even
and
more.
interest aside, if not more.
If not more, absolutely.
And they might clip you on your loan to value rates and things like that.
Absolutely. The financing, the money part is going to have an impact, whether you like it or not, on selecting that market, because you don't want to get into a situation where your returns are hurt, your pro formas are hurt, because now all of a sudden you have much more expensive debt. The bank is asking you to carry on much more expensive or much more capital in order to go ahead and close the deal. And then guess what? On the equity side, you're going to have a little bit of a tougher sell to your investors and having to explain to them, hey, listen, you know what? I need you to come in on me in this deal in Orlando or in Las Vegas because of X, Y, and Z. Where normally, very attractive, but who knows right now how long this pandemic is going to last? Go ahead and build in some hedges. Go ahead and build in just a cushion into your model for in the event this recession does last a little bit longer than expected. This COVID does, who knows? that you are protected.
Well, you get there by doing a great thing that we've been doing a lot of post-COVID is a sensitivity analysis,
Absolutely.
right? What's a sensitivity analysis and why is it so much more important to do in 2021 as we're starting to get into a new market now, right?
A sensitivity analysis, guys, is basically, okay, in the event that, and pick a variable, interest rates go up a little bit higher, 25 basis points, 50 basis points, or lower, depending on wherever you think interest rates are going. If rents go up higher by $25 or lower by 25 or $50.
Factors you can change: occupancy
rates, all the variables,
interest rates on the market,
and how those really affect and impact your returns when you start talking about IRR, cash on cash, whatever metrics you like to use to really go ahead and sell your deal. And then what you're going to do is you're going to put the percentage odds of those different cases happening. You're going to have a bull case, you're going to have a most likely case, and you're going to have a bear case. And you want to be conservative in your underwriting so much, you probably want to make sure that this deal still works based on your sensitivity analysis in the event that the bear case scenario plays out.
On that bear case, you don't want to see either negative numbers or marginal rates of returns your investors aren't going to be happy with. Going back to that deal that we looked at that's got the two bookends of two much larger properties. And let's say this happens. It's very probable that there is a drop in the stock market, that there is a drop in job market or whatever, and that pulls down unemployment rates go up again, and that means that that at the end of the day, people, occupancy rates drop in properties and eviction rates go up. That's very probable. And so to keep themselves occupied, those bigger complexes may say, you know what, we're going to start having rent specials, man.
That's right.
That's it. We're going to start giving first month free. We're going to start giving security deposit free.
That's right.
And you're going to have to chase them to stay up. And they've got more unit counts than you do.
That's right.
In that. So if you want to be able to see the market, see some flexibility in the market, especially in rents. By the way, the average rent on this property specifically that we looked at was $1,200. If rent dropped $40, 3% of it.
That's it.
The market dropped 3% in rental income. The returns to investors got cut in half.
That's right.
On this deal.
It's too much.
Forget it. I saw that. I said, nope, we're done. Bye-bye. So very important from a money perspective, just to cap it. Interest rates have changed on debt. You guys on that side of the money. So make sure you're baking in new conservative debt options for your deals. Your equity investors may want to see great rates of return, but you want to make sure that your deals are realistic, that can produce those rates of return, and have the courage to tell investors, hey, listen, I might not be able to get you 18%, but I can surely get you 14 based on my numbers, and here's my sensitivity analysis as well.
Right.
One last thing, on the money side, uber important to monitor your income and operating expense projections on these properties post-COVID and post-2021, because it's really going to make or break your deal.
Absolutely.
It's just going to, that whole flexibility, rents going up, expenses going down, whatever, is really going to be what makes it always makes or breaks a deal, but yeah, sensitivity analysis, I think, on those factors are really what matters.
We have some wild card variables going on. We have a new administration that's going to be sworn in next week. We're not sure exactly what's going to be happening with eviction moratoriums, depending again on what market that you're in and things like that, right? So, where you might have been trying to get a tenant out that's, hasn't been paying and hasn't been, a good tenant that's been taken care of paying you on time and in full, all of a sudden they have to linger into that particular unit for another 6-7 months. I mean, all of that stuff really, really comes back to her.
There's a lot of factors and a lot of variables out right now, and being sensitive to markets flexing through sensitivity analysis is the biggest way to go. We got being sensitive to markets and being market knowledgeable. We've got understanding the money on income, expense, debt, everything about your deal, and sensitivity analysis. Right. Number 3, what do you got?
Management. You could have selected a property in the so-called best market. You may have the best financing and you've raised the equity for
all
this
the equity you need.
All right?
I got a great deal, lots of money, all the debt. I got it going on. Check.
If you can't manage that property, you're going to be in trouble. You're not going to get out of the gate come day one. Your returns are going to hurt. They're going to suffer. You're going to have real tough explanations with your investors, God forbid a capital call, because you did not line up good management before you decided to go into that market and start doing your underwriting on the deals and so on and so forth. Let's be real. Property managements, I think they've been really stretched in 2020, having to deal with some of these tenants that, were right up in February of last year. They're about to get evicted. They can't get evicted. Eviction moratorium and so on and so forth. So property managers have been stressed. There are good ones out there. You need to interview the good ones. You have to make sure that they have experience in history managing the type of property that you are looking to purchase. So don't just hire a property manager that manages only type A properties. If you're buying a value add property and vice versa, and so on and so forth.
Make sure the property manager matches the asset class you're buying. So make sure your property manager manages a lot of what it is. But bottom line, make sure your property manager thrived during the last 10 months. The PMs that we use in the markets that we're in had an average increase in occupancy and collections of 10%.
Yes.
Isn't that great?
Yes, that sounds
during
good.
COVID,
That's
during Looney Tune time from March till now, right? They had an average 10% increase, right? And if your property manager has a solid marketing strategy and is able to attract tenants even with social distancing and COVID and everything like that,
lease up. Yep.
Lease up. If they're able to, if they've got a solid team and a solid business plan on those things, then you could be in good hands. But management selection is always key because you get a great deal, lots of money, lots of attractive debt. Everything's there, and it's all that's all theory until you have implementation. Right. The management side of it is really what makes a deal. That's what makes the gears turn.
That's right.
So property management's one side of it. The other side of it's asset management. Property manager is who you hire. It's the vendor you hire that runs the property for you. Asset management is what you yourself are doing or somebody in your team is doing, which is to browbeat that property manager into submission, not be afraid to call them out. They're responsible for the NOI on the property, the asset manager is. They're responsible for making sure the property is performing at its rate. It's just as important to select the right asset manager as it is to select the right property manager in 2021 and have someone who knows how to navigate all the different issues going on during COVID. And, it is a strong asset manager that can get a property manager to get their ear to perform, is not afraid to even fire a property manager if that needs to happen to get to the right solution.
Folks, your property is your race car, okay? Your property manager is the driver. You can have the best race car, but if you have a bad driver, you'll crash. You are interviewing that driver as much as you are running your numbers on the market and on the property that you are looking to acquire. Because the market and the property can look great. But if the property manager doesn't buy in and gives you great positive opinions on and her thoughts on the business plan, on how best to move forward in 3, 6, 9, 12 months, it's going to be very difficult for you to go ahead and execute on that business plan, on those performer numbers that you are selling to not only your investors, but to your lenders as well. So make sure you interview, I would say, a minimum of 3 to 4 property managers in whatever market you're choosing to invest in.
That's great. Those are your keys to success, guys. And at the end of the day, it is a new market. Markets, don't shop everywhere. Drill in, be a market expert. Money, bottom line. I'll highlight one other thing Hervé said. Make sure your deals need to cash flow day one. If your deals cash flow first day that you get in, if the market takes a dip or prices get cut in half or whatever, if your deal cash flows, you can ride out a dip. I had properties that cash flowed before the 2008 recession. And you know what they did after 2008? They kept cash flowing. And in 2009, they cash flowed. I couldn't sell them because they were worth like half what I paid for them.
That's right.
But guess what? They kept cash flowing, and the market caught up. And I eventually liquidated them. I had to hold them longer than I wanted to.
That's right.
But at least they cash flowed. Imagine if they were upside down. If I was losing, and I was like, I'm going to take a bet that it's going to go up in value in the next couple of years or whatever, I would have got my teeth kicked in.
Absolutely.
But they cash flowed, and I was able to ride the wave. And then I sold them a while later, but I sold them at a profit once the market had a chance to recover. The bad inventory got dissolved and got absorbed and back into the market and stuff like that. So if your deal cash flows, that's an enormous imperative play in 2021 and forward. And management, as Hervé said, I love that race car analogy. So that's it, guys. Here's your keys to success. Hervé, thank you, man.
Appreciate
you.
Oh,
if
absolutely.
you guys want to interact with Hervé and I or hear more about, or just talk more about these things, please leave a comment below. We want to hear from you guys, and we'll surely get back to you. Expect things to change again because we're in a dynamic space. The market's not going to continue to just be as steady as it was up until recently. Things are going to change a bit, so it's even more imperative to keep your ear to the ground and watch for changes and look to changes that are happening in the economy and see how it's going to affect the real estate business.
Absolutely.
Thanks for watching, guys. Have a great and profitable week.